Welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into some stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. But I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable ones, all produce high free cash flow. High free cash flow. That's why I'm looking for high free cash flow. All the best investors depended on free cash flow and evaluating a company's ability to generate free cash flow. A company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but are big cap stocks gonna come back? Gonna come back? Chinese stocks are exploding. The dragon has awakened in China. And could be the best trade we've seen in a while. AI hype is really interesting. AI is going to be interesting in the future, but is it really a business today? I'm going to pass on this stock. Just not enough discount, and I'm not really believing that they're going to grow as well as they should. Options can make your performance go a little higher every month and generate nice income. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their videos. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock, and it's unappreciated at this time. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor and you will build great wealth. Hey everybody, welcome to my live stream. Thanks for showing up. I appreciate it. It's been 4 crummy days of stocks trading lower, and it comes to the territory, man. It's a little bit like, football games. Everybody remembers the finish, right? Where they're presenting the trophies and all that stuff. But down in the trenches, those linemen, they're sacrificing their bodies. They're freaking just going through a lot of pain and suffering and just beating each other up. And today's a little bit of that tough day, a lot of carnage out there. But keep in mind that you can get very, very wealthy investing in stocks. I looked at Warren Buffett's portfolio, and he did not beat the market every single year. He beat the market 5 out of the last 10 years. And overall, he beat the market, let's say 50 to 60% of the time. And some years he was way behind the market. So just keep that in mind, that even some of the best in history, they have bad times. And today is the 4th day of a down market. There's a lot of fear out there. And it's just beginning, FYI. I'm not hoping this, but this may be the beginning of a pretty good correction. Right now, all I could do is call it a pullback. In some cases, some stocks are getting hammered, and I wanted to show a few examples of some of the price decrements or the drawdowns in some stocks. And some stocks, frankly, were set to do that. They had gone up so fast. Their fundamentals were nowhere near the valuations that you need to have a stock price be 100 PE or 200 PE. Just insane. So those stocks coming down is actually good news in my book, because if we're going to be in la la land of stock prices, man, it's going to end really, really badly. So just taking some of that medicine and having some of those stocks come down is not a bad thing altogether. And being a long-term investor, if you can work a little harder during these downturns, make a little more cash and have it ready so you can buy great companies, that's proven to be, in my life, a really good idea. I've lived through downturns, and putting money in the market when things are really bad is the best idea I probably executed in my investing life. So we're nowhere near a correction yet. So maybe I shouldn't be talking about it too much. But hey, let's get going here. It looks like Bear Light, good to see you. Thanks for joining. Magical Self. Sergio, what's up, man? And then Shadow Guy, my buddy Shadow Guy. Bonds are standing nice and tall. Bonds are like, they're like in a tuxedo right now. There's all kinds of chaos, and they're just walking down the street just at normal pace and just going about their business. Stocks are losing, and there's a lot of risk. There's a lot of fear, as the fear gauge that I've got on the screen would tell you. But bonds are where right now it's very calm. They're actually going up in value. And that's why, especially older investors like myself, we own bonds, because that's where you put your money that, hey, that's the money that if I have to live on my investments for the next 5 years, that's handled. No problem at all. And I put it in bonds. I don't put it in stocks, because if you lose like 20, 30% of your stock portfolio, and you're also eating off that portfolio, meaning you're paying your living expenses and your health insurance and so forth, it gets pretty stressful. But if you have it in bonds, lower stress. Omar, good to see you. Good to see you. And then Jao Rocha, how are you from Portugal? Thanks so much for joining. You want to look at EVGGF. We'll take a look. Never heard of it. Carlos, a regular. Be greedy when others are fearful. I agree with you. Just be aware. We've only been in this environment just a little while. We're not even close to a lot of fear being in the streets. If we can get this NASDAQ down like 15, 20%, then we can start talking about, be greedy when others are fearful. Our buddy Warren Buffett, he's got over $300 billion of cash ready to go. And that'll be interesting what he does with that cash. So I noted all the stocks you guys want to cover. We will cover every single one. And for now, I wanted to kind of open up with just a couple of big observations and look at a couple of stocks that I think are really getting their stock prices are going down fast, but it was somewhat warranted. Explain as I get into those stocks. All right, so the market, the NASDAQ is officially in negative territory for the year to date. And you see how the NASDAQ's just gone sideways. The market doesn't have a specific direction. If we look at the 1 year, right, it had a direction for a while. Like these directions, people are buying into the market. And of course, you have some pullbacks. But this year, we've had no direction really since December. We're pretty much going sideways. And that's, I think, the symptom of stocks are really expensive. Fundamentals are not propping up the stocks. Fundamentals are not showing that, hey, these stocks ought to be higher. So that's expected, because we've had just a fabulous stock market. In 5 years, you more than doubled your money on the NASDAQ. I am very happy with that. Good job, NASDAQ. If this was an employee, I'd say, look, you're You have brought value to this organization, and thank you for having a 125% rate of return. But the last, couple months have not been good. Now, this thing can turn negative, and I'm not hoping for it, but it could, and really have a nice drawdown. We had one in 2024. It went down 13% on the Nasdaq, so it's not something crazy or out of sorts. So that could happen. On the S&P, it's a little more stable. It's still up 1.73, but it too is kind of going sideways for a little while. The Dow is having a little bit better time. And again, it's kind of slumping a little bit. Small caps, I don't like the Russell 2000 as an index reading because there's just too many stocks in there. And you have some really good quality stocks in there that kind of get ignored when you see, hey, this index is down 2.33%. But at the same time, I can name like 10 small caps that are just going through the roof. So those kind of get lost within this big index. So that's where that's at. Okay, so the indexes are down. It is a real nice little correction we're dealing with here. It's down 3.84 from the recent high. It keeps going. We'll get to minus 10% now. That's what's going on, kind of high level. Let's look at some specifics. If we look at sectors, healthcare was in the green today. So these are pharmaceutical companies, healthcare, insurance companies. Real estate was in the green. Financials were in the green. Staples were in the green. And then everything else was in the red. And technology was nice and deep in the red today. And we look at year to date, and we have a new leader of the pack, and that is healthcare. Healthcare is leading the pack. Materials, second place. Communication services in third. Staples, financial services. And technology is just inking out a gain. Still in there. Over the last month, it's down 3.12. And I am very optimistic that healthcare is going to do well this year. That's why I'm buying into that. That's one of the sectors I've been buying into. So that's what's going on out there. Mike, the dividend investor guy. Nice long comment. Let me read it. Some REITs like Vici and EFC are doing well. Yep, right there. They're in real estate. And some BDCs like OBDC, HTGC, doing well. Yep. Yeah, it was interesting to see how nice software held their value today, and New Holdings bounced back. New Holdings went down a lot yesterday, and I should say Friday. And then today it bounced back. That was very good to see. Very good to see that New Holdings. There was a lot of buyers in New Holdings that wanted to be in that stock. I think they saw what I saw in the earnings, which is the company operated really, really well. So good stuff out there. And so I'm glad that, real estate did have a good day, and it's having a decent year to date, and it provides a nice income too. So good stuff there. Now looking at the heat map, the big caps, Nvidia went down 3.24. And I'm going to take a look at Nvidia. I'm probably going to look at Nvidia all week. And as you likely know, Nvidia is going to announce earnings on Wednesday and talk about like the main event of earnings. I'm going to talk about that in a little bit. So I'm going to save my comments. Microsoft down 1%. Microsoft did come out and say they kind of changed their tune. 2 months ago, they were bragging about, man, we're going to spend so much money on that data center, man. We're going to spend so much money. It's going to be we're going to have the biggest data centers and so forth. Now they're saying, well, we're going to lease. We're not going to buy. We're not going to spend CapEx. We'd rather lease and kind of pay as we go. And that was a sign that they got it. Investors sold off Microsoft because they were just spending their, too much CapEx. and they got it. They're like, okay, yeah, we get it. We're not gonna like spend just crazy amounts of capex. So it's a signal that hey, they're gonna pull back that capex. They're not gonna buy, everything that Nvidia has to offer and Broadcom and so forth. So these stocks in Nvidia for a good part of the day was in the green, but then it really settled in the negative. Broadcom down 5%. Qualcomm went down, AMD down. I mean, it was just a bloodbath in semiconductor. Our friends at Amazon are not immune. They were also spending a lot of capex. I mean, these three big companies here, Microsoft, Amazon, and Google, were kind of in a space race. Who can get the biggest data centers and who could boast about having the best AI capacity? Well, that kind of story has now gotten old. It's kind of like, there's no killer apps out there. There's no AI app that I can't live without. In fact, I got to push myself to go use AI. Like, oh, I'll go try it out because my life hasn't really changed since AI was announced. So these guys are spending a boatload of money, probably several boats. You'd have to get like those big giant ships that they put like 1,000 containers on. That's the kind of money that were blown away, and they're going down. So these three amigos, that's a lot of market cap that's going down, and a good part of the technology slump is right here. This is where it's at. Our friends at Meta were doing great. They had a 20-day or 20-day closing in the positive streak break, and now they're on a negative streak of 4 days going down, and each day is not like just barely negative. No, it's like 1.5, 2.26, 1.5, 2. So they really have come off their high rather quickly. So these big stocks are really feeling it. Apple, of course, is like they're just kind of standing in the corner trying to avoid all this, and they effectively did that. 0.66 to the positive. Here's healthcare. It's doing quite well. Everything but United Healthcare was moving. CBS was down a bit. So that's the heat map out there. We went over the stock sectors, looking at these big giant stocks that, are most of the value in the S&P, especially. Apple is still down for the year, but it held its stock price higher today. Nvidia in the red. Microsoft in the red. Amazon red. Google red. Meta in the green, but this was as high as 25% year to date. So it's given up 11% or 11 full percentage points off of where it was. Tesla down nicely, 18%. That is correction territory. Broadcom correcting 10%. This is overpriced. I was a Broadcom stockholder, made money, sold it. And Berkshire went up nicely. Look at that. These guys won the day, most definitely. 4% to the high, or up 4%. And on a day when it was kind of a crummy day, so that is actually, I give them more credit on a day like this. TSM is down. Healthcare, Eli Lilly, maybe that's going to be the next $1 trillion market cap company. Walmart was down. JP Morgan was down. So just a lot of red near the top of the stack. And that's what happened. We had some interesting earnings come out today. Nothing gigantic. Zoom announced. I recorded a video, published it on my channel if you want to take a look. I can definitely comment on Zoom and kind of give you the highlights there if anybody's interested. Or you can watch the video. I covered Domino's early this morning. It was selling off. And it's the pizza business, slow growth, little profits, and it was selling off. And I think as I think about the pizza business, right, it's just going to get harder and harder because now you have DoorDash, Uber Eats, and you can get any kind of food, delivered to you. So I don't think like pizza, one of when you were like, you got home late, you're tired, you have a family, you're like, let's just order pizza. But now you're like, hey, let's just order whatever we want. And it doesn't have to be pizza. You can order Chinese, Mexican, Italian, you name it. Healthy, not healthy. Boom. Put it on your Uber Eats app, put it on your DoorDash app, and it's at your door in 20 minutes. So I think that big causal factor is going to keep weighing on Domino's Pizza. That's why I thought their stock price went down. I looked at Owens Corning, and I know there's some value guys out there, and it looked pretty good. Looked pretty darn good. In fact, we'll take a peek at it because I thought the fundamentals look really good. It's a boring stock, but the money spends the same, whether you bought a stock that's super exciting and super cool, or whether you bought a really boring stock and it made you a lot of money. The money spends the same. You can buy a car with it just the same way. You might get more style points by, hey man, I bought this one cool stock and it went up, as opposed to you buy a boring stock like a Kroger. That's a pretty boring stock. Well, I've made a lot of money on Kroger, so whatever. Owens Corning is a little more like Kroger. Hims, man, we're going to go over Hims because that one got taken out behind the woodshed. It's still behind the woodshed, just getting beat up, just getting pummeled. And we'll take a look at a couple others too. Oh, Tempest AI. Speaking of crazy overpriced stocks, that's going to be a little surprise for me. I'm going to leave that one and marvel at whether it's up 50% or down 50% in a day. Hey, thanks for joining, everybody. We're 20 strong on the live stream. I don't know if I said hello to Omar. I think I did. Let's see here. Good to see you, Omar. And then, so Omar, you're thinking of new holdings. Let's take a look at new holdings. And Khalil, good to see you, man. I've seen you a couple of times. Very nice that you come back. And you want to look at FTNT, glad to. And then Coco. Not familiar with the symbol, but I will be after we look at it. And of course, Instacart. Let's take a look. Trader Prad. What's up, buddy? This is my favorite trader on YouTube right here, Trader Prad. And if you want to see somebody check out stocks and go through his process, he's on, I think, in about 8 minutes. He's excellent. And he's on weeknights and I think on Sundays. So good to see you, Prad. And I hope you're making money off this volatility, buddy. I hope you're making a lot of money. And Mike, the dividend investor guy. So you're a little surprised on the security side, right? And I'm gonna give you some comments there. We'll take a look at FTNT, Zscaler, and then S, which I forgot their name. I think it's Sentinel, right? Sentinel One. But we'll take a look at them together, and I'll give you some comments on it. It's just some stuff that I see. Mr. 123 Cheetah, good to see you, man. It's been a little while. And you want to look at TXRH. Perfect. So just bear with me, guys. I think I've got 14 stocks on the board. Okay, so please be a little patient. I'm going to get to every single symbol. And just be a little patient because it might take me a little while to get to your symbol. But let's get into it. And Trader Prad, you are welcome, sir. We know when you want to stream together. I like when we bring two different views on stocks, a trader and an investor. It's pretty cool to listen to you, and I hope you get value from what I've got to say. All right, I'm going to start with the stock that everybody's thinking about. That's Nvidia. And I want to begin by stating the obvious that Nvidia is a great company, and their brilliance of creating GPUs is pretty much, stated and clearly expressed. It's an awesome business. It's just really expensive. And I've always maintained that the semiconductor space is cyclical. And for a semiconductor company to get up to $3.22 trillion, there's an expectation in that valuation that, hey, they're going to be making this kind of money, this kind of growth for like 10, 20 years. And it's like, well, I don't think so, because then all the companies are going to go broke. Like I showed you when we went into the heat map, Microsoft, Amazon, Google, their stock prices are going down because they were bragging about, oh, we're buying all kinds of Nvidia GPUs and building out our data center. And the market goes, you know what? I think I'm gonna sell your stock. That's that's not wise. You're spending your capital on a business that is not proven. If it doesn't work, you're gonna burn all that capital with no ROI. So they got the message. Our friends at Microsoft are like, well, we're going to start leasing. We're not going to build out data centers like as fast as we said we were going to. And I think Amazon's also really good at listening to what the market's saying. And our friends at Google, I think they're going to do the same. They can't ignore the obvious, which is, hey, your stocks are selling off. The market doesn't like the message that you gave them on your earnings. Having said that, Nvidia is going to announce on Wednesday. And I mean, everything, the whole market is on the back of Nvidia. If they come out and say, man, we crushed the last quarter, and what's their fiscal year? So their fiscal year ends at the end of January. So it'll be a completion of another fiscal year. And I expect that they're going to say we crushed the year, but everybody will be at the edge of their seat around guidance. And here's the reality. The law of big numbers. When you're 11 billion in revenue, yeah, it's like logical. The math is when you go from 11 to close to 17, you grow 53%. It's a very good growth rate. That is incrementally roughly $6 billion of additional revenue. And then they had these 2 years, especially from 22 to 23, you had very little growth, and then it ballooned up to 113 billion. Now, if anybody's imagining that, hey, they're going to keep growing at 100% and they're going to put another $1 billion of revenue in what will be their fiscal year 2026, because they're in fiscal year 2025, that ended at the end of January. They'll report it on Wednesday. That's very hard to believe because businesses will go broke. AWS from Amazon will go broke. They'll be like, man, we don't have any money. We can't even pay the electric bill because we bought too many GPUs from Nvidia. The Chinese can't buy Nvidia product. It's illegal to do that. And of course, DeepSeek. Chinese came out with DeepSeek and said, hey, since we had a constraint of having processing power, we figured out a way to get large language models built at a less expensive way. And that is expected in technology, by the way. Over time, technology gets less expensive, more powerful. The customer gets more for every dollar they spend in technology. So these guys are going to be, I think, comparing, like as you compare the quarters, right? When you see the sequential growth, they grew from Q2 to Q3. They grew it by 5 billion. Here they grew by 4 billion. Here they grew by 4 billion. Okay. And that sequential growth is what I've been kind of looking at. And when we get that earnings, if it comes in at like 36 to 38, I think this stock's really going to sell off because the writing's on the wall that they peaked, and it's going to be hard for them to grow. If they come in at like 45 billion or something like that, I'll tip my hat and say these guys are incredible. And the tank still has some gas. They're driving the car at like 150 miles an hour. The miles per gallon are not very good when you're driving at that velocity, but the tank may still have some gas. So I'll be looking at the sequential growth. and their guidance. Now, their CEO 2 years ago was like super rock star material. He was doing all kinds of like, you know, PR and a lot of press. He was in the news all the time. I haven't heard much from him. And he's trying to spin the whole DeepSeek story like, oh, well, that's good news. That means that it's going to be less expensive and more people are going to use AI. So we win. It's like, no, that's not the way it goes. You know, that means that they can use alternative technologies other than Nvidia to do AI, and that cannibalizes the Nvidia business in my book. And Nvidia shouldn't be happy about, hey, we used to charge $30,000 or $50,000 for one of these premium GPUs. Now, thanks to DeepSeek, we can only charge $5. That's bad news. That means your unit cost, your unit price that you sell it for is going down. So a lot of things are going to be disclosed in 2 days. And boy, the stock market is going to go silent. I think for the hours after earnings, everybody will be looking at this earnings. I will try to live stream. I'm pretty sure I can live stream. And we will take a look at the financials, take a look at the earnings, we'll take a look at the guidance. I'm going to stream after the earnings call so I can listen to it, because that's going to set the table. We're either going to keep correcting and the stock prices are going to continue to fall, or we're going to catch a little rally and we'll see where we go from there. But there's other factors that I'll talk about in a bit, but just to finish things off on Nvidia. So this stock is going to report. The forward PE is 33. That's not too bad for a growth company. And the PE ratio for their fiscal year 2025 is 51. So we shall see. We shall see. When I look at Nvidia, I try to be rational and optimistic at the same time, because I'm in disbelief of Nvidia's ability to kind of defy what has been an industry attribute, which is it's cyclical. Intel followed a cyclical pattern. The semiconductor industry has followed a cyclical pattern. And I give them a really strong free cash flow forecast. It still comes up really short of their market cap. And free cash flow is the way that the big massive cap companies are valued. You look at Apple, they make a lot more free cash flow than 75 billion. They're north of 100 billion. And they're consistent. It's a handheld smartphone. That market, they sell billions of those units, and they have a market, right? And they have an ecosystem and so forth. Nvidia is trying to sell business to business these GPUs. But having said that, I still try to give them as favorable numbers as I can, and I just come up way short. The stock is priced 53% too high if I just depend on free cash flow. If I bring in their earnings per share, I think it's fairly priced if you just look at earnings per share. But earnings, Charlie Munger did not use earnings. He hated earnings because it could be manipulated. There's a lot that you could see that's very positive today that turns really negative in a year or two, and then you're sitting on a stock that went down in price. But free cash flows tend to be the best test for a company's true value. Having said that, I think Nvidia is priced too high. And I am currently in a short position with Nvidia. I bought a put option, and it's going to be open. I can exercise it between now and up until January 2026. And right now I'm in the green on that put option. So I haven't recognized it, but I made a little bit of money. And I think that the Nvidia stock, if things happen, kind of things run their course, I think the stock can get down to near $80 a share. It's currently trading at $130 a share. And we'll see. We'll see. I've been talking about Nvidia respectfully for a while, and you can check my videos, or you don't have to, but right around here, I started to say that just guys, this is not sustainable. And since I started to talk about it, it really has slowed down the appreciation. And I started to short the stock, and I started making videos, and boy, did I get a lot of colorful comments. And I went from being a total idiot back here, where people are like, you just don't understand it, man. Look at this stock. It's going to fly off the charts. I go, yeah, you might be right. The market may teach me that this stock is going to keep going up forever. It's going to be the first $20 trillion market cap company, I guess. Yeah, that's completely possible. But instead, the market went sideways. And I'm glad that I documented kind of like what I was running the numbers. I'm not like, I didn't make up the numbers. Nvidia reported them. And I'm like, well, either my process is, I got to throw it out the window, and I got to unlearn all the stuff I read in the books that, investors have written in books that I've been reading for 30 plus years, or maybe I'm onto something here. So we'll see where it goes. They could surprise and just overwhelm us with positive news this week, and it keeps going up. But the fact remains that, man, for 8 months, the stock's doing nothing. It's underperforming a market that went up over those 8 months. And these compares on the stock price, right now, the annual is up 64 because it's comparing to a stock price of 78. But you fast forward to the June of 2025 timeframe, when you're comparing against 135, and investors begin to look at their stock and say, I'm either down on Nvidia over the past year, and these hedge fund managers and big investors, I think they're going to really start to ask themselves, this trade is really tired. This trade is not working. We'll see. The stock that, is the classical example of what happens to stocks that just went up way too fast. And our friends at Super Microcomputer are doing this. This is Cisco.com bubble. Great company. Still is a great company. Best technology for networking ever made for this era. And they flew up. They were the most valuable company on the exchange. Sound familiar? They came out of nowhere. Sound familiar? They kept growing their business, but they just, the weight of that stock price just crashed down, and they've never gotten back to that stock price. And that is 25 years later. Cisco has never gotten back. And now they're bigger than they were 25 years ago. It's just the stock price got super crazy high. Let's look at the max chart. Whoa, does that look familiar? When a stock goes up that fast, maybe this one is going to be different, but maybe not. You can also look at Intel. Intel had the same kind of chart. We look at our friends at Super Microcomputer, which I did want to look at because I was curious. I made money shorting Super Micro this past 12 months. Because when you look at Super Micro, see how it just shot up and then it came down. It was a falling knife. So it was a good stock to short. I started making videos on it. Hey, this thing's insane. This is not Nvidia. They don't have intellectual property. They don't have patents that they can hold their product in the market and charge higher prices. Now, this thing has been kind of a, roller coaster, going up and down, up and down. And more recently, I think some people can claim, hey, but look, I caught it here and I was able to go up 186%. I'm with you. But boy, over the past year, this thing has been all over the place. I think the market's telling us this business is not desirable. It is a 30 market cap company, $30 billion market cap company. And that's how things end with these really overly priced stocks. I'm not going to play this game of trying to buy it and then sell it again. Some other people maybe make a lot of money with her, but I don't try to. I made my money on super micro shorting it. I picked a good spot. I don't know where. And then I sold around here. I made like 50%, 52% or something, sold it. Okay, I'm done. And the point was made. I've also lost money on short trades, by the way. It's not easy. More than anything, I did it on principle. It's like, I think this stock is overly priced, and it worked. So that's super micro. I wanted to cover it. It looks like for the, what are they doing for last month? Up 55%. And then we've got the 5-day, they're still hanging in there. For the 1 day, down 8%. I think there's a lot of pain and suffering coming for super micro. There's, super micro is riding the coattails of Nvidia. But super micro is a hardware company, and hardware companies just don't have a lot of intrinsic value. When you compare like Nvidia, they have like 85% margins, gross margins. When you look at these guys are just battling to get decent margins, gross margins, 14%. It's like, man, you got to sell so much more revenue to get the same gross margin as Nvidia, because Nvidia holds the patent on their GPUs. They make so much money per unit sold, and our friends at Supermicro don't. And then their free cash flow is negative. So this is just a business that, man, I do not like buying hardware businesses. I learned my lesson with Sun Microsystems, and you might ask yourself, what the heck is Sun Microsystems? Back in the .com bubble, .com days, I should say, that was the best hardware provider. And I lost a pretty good chunk of my investment in Sun Micro. So that taught me, hey, hardware companies are not desirable. So I had to pay a pretty good price on that lesson, and the lesson stuck. So that's super micro. We went over Nvidia. Let me check the comments. James, thanks for joining. BBAI, put it on there. Just be a little patient. We got a lot of stocks on the board that we're going to be covering. And Sergio, I wish you'd bought the dip on Super Microcomputer. So, I would not invest in a company that cannot produce a 10K. I'm just asking for my money to be burned, for somebody to put gasoline on it and burn my money. If a company cannot produce a 10K, it's like, what are you buying? A 10K is basically a set of 3 financial statements, principally your income statement, your balance sheet, and your statement of cash flow. It goes to the SEC. It gets provided to all investors that are interested in your stock. They can't produce the 10K. It's like, guys, it's like if you're in high school and you don't know the ABCs and you finally are beginning to learn the ABCs, nobody's congratulating you. They're like, dude, why were you not like paying attention back in grades, like elementary grades, and you learned your ABCs and you learned simple arithmetic? You don't congratulate Super Microcomputer for finally getting a 10K out the door. It's like, no, you guys should have been able to do that. It's kind of nuts for you to like not be able to produce that. And I know that their auditor fired them, quit. That's a really bad sign. So you invest any way you want. I'm just telling you, I would not touch Super Microcomputer. I would not deal with it. I have no personal experience with Super Microcomputer. I have no beef with them. I'm just saying there's some things where there's a reason why the SEC and the investing community expect the companies produce accurate financial statements on time. And they also expect that the accounting industry that audits these companies are very accurate in their opinions. So when a company gets fired by their auditor, that's really bad news. And then they can't produce their 10K. Okay. I can't touch that business. I've worked too hard for my money. And if you want to make a fast buck, good luck. Good luck. But if you want to make a lot of money over a long period of time, invest and compound your money. And you'll wake up with more money than you'll need. Alrighty. So moving on. Let's talk about HIMS. It's down 18% after they announced their earnings. Now, HIMS is a little bit of what we're seeing, right? We're seeing stocks just take off. And I'm going to show you Robinhood in a bit because I own Robinhood. So I just don't want to badmouth a bunch of stocks that I don't own. And I've been talking about this being like overpriced for a little while. I released a video a week ago, maybe 2 weeks ago, commenting that HIMS is just really overpriced. And these guys here are beginning to fall. It's beginning to develop a falling knife kind of pattern, I should say. They call it a falling knife when it becomes like this. This is a falling knife. It's a knife that you don't want to try to catch because if you don't catch it right, it's going to cut your hand. And you're going to be at the hospital getting 36 stitches on the palm of your hand. And the doctor's looking at you going, why did you try to catch that falling knife? And you're like, because I thought I could catch it. And the doctor looks at you, shakes his head and goes, that wasn't wise. So that's a falling knife. So when this pattern, and this is like I was saying that HIMS is too expensive on its way up. Now it's beginning to form that pattern. So we'll see. We'll see if they can keep themselves from being a falling knife. But I don't think so because it's going to fall 18% tomorrow. This graph does not show the 18% decrease that is expected when the stock opens. This one's going to be ugly. It's going to come down 18%. It's going to come down to 42. So it's going to come down to here. And who's going to buy it? Who's going to say, oh yeah, HIMS is a great business. They just lost the ability to sell weight loss drugs, which they had the exception to do so around the patents of Eli Lilly and Novo Nordisk while there was a shortage of that drug. But now that those shortages have been dealt with by those two companies, they can't do that anymore. If they do, they're going to get this, you know what, suit out of them. So HIMS is just like in no man's land. Man, what are you going to do? How can you make your stock go up at this point? Now, one thing I didn't do with HIMS, and I think we can do that together, is update my numbers. So here's HIMS, and before I update the numbers, it's overpriced by 54%. Now, if it goes down by 18%, down to like 43, this is going to turn into like a 38 or so, right? So it's still going to be overpriced, but it's going to be correcting, getting more towards its intrinsic value. But let me take a peek at where their financials came in. I hope Stock Analysis has updated everything quickly. All right, good job, Stock Analysis, getting it done. Now they grew their revenue. Let's take a look at their financials here. We'll look at them together and then I'll update my model. So their revenue is really good, right? No doubt about it. But in here is that weight loss drug. So it's like, yeah, you were selling a drug that's on patent. Now you can't sell it. So how are you going to replace that? And their guidance is what's tanking the stock. Well, their margins shrunk, and their guidance is that, well, we don't have something to replace it just yet. So the revenue is going to contract or flatten out. And when you're paying a PE ratio of 96, you're not buying flat sales. You're buying 69% revenue growth. So if you're telling me you're going to grow at like 10% next year or 20%, we need to correct this PE. This PE needs to get down to 30, 40. Well, if you do that, the stock's going to go down by like 50, 60%, which is what analysts are saying. It's overpriced by 41%. I'm saying 54 before I updated my numbers. So that's where we're at with HIMS. So let's update those numbers on the fly. All right. So our free cash flow number, that we're seeing for the company, $209 million of free cash flow, which is a very good number. And I'm going to take that number. Now, knowing that they're not going to grow as fast, yeah, we'll grow it by 15%. So that's 209.43 times 1.15. And I'll update my notes here. So the intrinsic value of all these cash flows growing them by 15%, which may not happen because how are they going to replace the weight loss? They're probably going to have to invest quite a bit in the business to try to get some new products to fill in that gap. So the cash flow may go down, but I'm going to be optimistic just to give them the benefit of the doubt. And that's what they're going to grow over the next 4 years. Then from there, they're going to grow up 4%. This is listed as a consumer staple, which is interesting because they're not a pharmaceutical. They don't do drug discovery and all that stuff. They're kind of selling products that they think the consumer really wants. And they're trying to message it that, hey, you don't need this complicated, go to the doctor and get drugs that are going to cure your illness or stuff. Take the shortcut, come to us and we'll sell you this stuff, which, in some ways is probably a value add for maybe these light conditions. Like, hey, I want my skin to be, more supple. Okay. Yeah. Go to Hims. But hey, I think I have a disease. Go to the doctor. You go to the doctor, get a professional to tell you what the heck's wrong. All right. So let's talk about cash and debt. So Hims has 300 million in cash. Nicely done, fellas. And they have 11.35 of debt. Nicely done. So when I update those numbers, and I am using 9, which is a little higher than, let's say, an Nvidia or an Apple. And that's because this is a smaller company. There's greater risk. For example, they're not allowed to sell weight loss drugs anymore. So that's a big risk. Smaller companies have higher risk. So based on their cash flows, they're overpriced by 44%. Now, one thing I will look at is how many people are shorting the stock. Oh, I don't have that information. But boy, the shorts must be circling Hims big time right now because some shorts made money this week on Hims. All right, so we got that there. Now let's take a look at their forecast of earnings per share. And before I do that, let me show you what I'm seeing because it is interesting to see that I'm not the only one concerned about the Hims stock price, right? It's 51, 14 analysts. There are analysts saying it's worth $11 a share. Okay. On average, they're saying it's worth $29 a share. And one is very optimistic, but his optimism is not that high, $68 a share. So on average, they're saying it's overpriced by 42%. When we look at their revenue growth, and this is the fiscal year that just ended, then it's expected that this stock is going to grow at 15% and then 23%. And that's where the PE, if you're paying 72 for a company that's growing 15%, good luck. That's going to be a really rough road because you're going to lose a lot of money across if you buy 10 companies that look like that, I would say that 7 or 8 out of those, you're going to lose money. Unless they have prospects of, hey, we're going to go from 15 to 50% growth, or we're working on some new product that's really going to take off. So this one here is, really going to slow down. And this slowdown, I think investors are going to leave and say the PE is too high. And they're already leaving. That's why we got a stock collapsing 18%. When we look at the last 5 days, down 12%. Look at the last month. We look from the peak to where we're at now, 25% down. And then you got to consider the 18 that in the after hours. So it's going to take the stock down to 40% or more, or less, I guess. So that's a pretty good correction in one stock. And this is the kind of stuff that I'm seeing that's healthy for the market. This is not sustainable. When a stock goes from here to here, right? These guys didn't discover a drug that cures cancer or something. The market sure treated it like it. Like, oh man, look at them. They're awesome. 833% rate of return in about a year and a half. All right. That's not sustainable. They have a cool website. They have a cool idea. Got to hand it to them. Maybe they're worth, from this point, maybe they're worth 50% more. But to go up 833 is just really nuts. So to see the market correcting that type of exuberance, I think is healthy for the market. Get some of these stock prices down that really shouldn't be that high to begin with, is my opinion on that. So that is HIMS, man. It is a rough road for investors on HIMS, and we'll see how it ends. We'll see how it ends. All right, one more, and then we're going to get into the list that you guys put forward. I'm going to probably get through this quickly. I'm not even going to look at their fundamentals. But Palantir has been super interesting, to say the least, for a couple of years. And all right, so we got this stock that just went parabolic beginning August 2nd. Man, rock and roll. Woohoo. Let's go up 381 in how many months? So that is 5, 6, 7.5 months. Okay, well, that's not normal, but it's pretty incredible. And now we're seeing the stock really come down 27%. Add that additional 3, we're down 30%. They're not going to announce for a couple months. And a big part of why Palantir is, I think, coming down is, you look at their PE is 480. This is a software company. They do big data. Their proposition is, we can help you see patterns in data and then predict certain things. Got it. The software industry has been providing those solutions for 20 years. It's not a new concept. They may do it better. I'll give them that much. But it's not like a discovery of a brand new thing. Like AI is supposed to be the discovery of a brand new thing. But AI, there's not really many use cases that I'm seeing around us that are really changing our lives just yet. So we'll see where this one goes. This PE has been incredible. I don't hear of many people arguing that, hey, no, Palantir can really go up more. Although the smart money is like, okay, these guys are in no man's land. This could develop another falling knife. And we'll see where it goes. So Palantir going down the after hours. All right, let's hit the list. A guy that's been waiting for a while. Let me catch up on comments really quick, and then I'm going to get to the list. So James had BBAI, got that one. Sergio, the man who's willing to take risk on super microcomputer, got your comment, buddy. Good luck. And then Vaughn, you want to take a look at the Honest Company. Now, we've seen the Honest Company. It wasn't all that great, but let's take a look at it again. Maybe things have improved over there. All right, so let's get into I wanted to see Tempest AI. Oh no, you can't tell me this awesome company that has no PE, no real fundamentals, is losing $743 million on revenue of 693 with a $11 billion market cap, is down 11%. Whew. Wow. That is something to see companies valued that much that really aren't doing anything that's profitable. So Trade Desk looked interesting, and here's why. For a while, this stock really got things done. It went from $17 up to above $125. Nicely done. Nicely done, Trade Desk. But over the last year, this thing has come down. It is slammed down. Now, I did a video and released it this morning of a investor, Pat Dorsey. And one of the super impressive moves is Pat Dorsey made a ton of money on Trade Desk, and he sold before it collapsed. And I'm like, whoa, that guy is really good. He's my favorite super investor. I covered that in the video that I did. But Trade Desk has caught my attention because this is a growth company. It keeps growing. Look at this green on the screen. That looks good. Green looks good. Not the biggest company in the world, 2.45 billion. And they do their brokerage. Let's take a look at their profitability. Free cash flow, that's really nice. Look at the growth rate on free cash flow. Nicely done, Trade Desk. That's what we want to see. And we've got margins of 80%. Awesome. 80% margins. Profit margins, 16%. Free cash flow margins, 26%. Think of like a bank account, right? And you're like, put my money in here. And of course, banks are going to pay you like 2-3%. But what if they said, no, we're going to pay you 26%? I would take all my money and take it to that bank and go, hey, you're going to pay me 26%. Here's my money. Pay me that 26%. Well, that's what this business is doing. It's paying back the business 26% of cash. That's phenomenal. So that looks really good. Now, their free cash flow is 641 million, and that is looking really good. My guess is I would value this company. Let me just make sure they don't have a bunch of debt. Nope, they have more cash and debt. Okay. So I would value this company around 22 billion to 25 billion. And I'm doing that top of my head based on their free cash flow. And they're above that. So I'm like at 25 billion on the high side because their cash flow is where it's at. This is just priced a little too expensively. And the stock is really settling down. Now, a part of why I think the stock is too expensive is it spent 5 years going up. You more than doubled your money. If you bought the stock way back here, you're still happy. You're like, man, you doubled my money and plus added 45% on top of that. So the stock price just got expensive over time. So that's what's going on with Trade Desk. I would pass on Trade Desk, and I'm in Robinhood. That's my brokerage stock, and I believed in Robinhood early, and these guys are doing really well. They came out, they IPO'd, of course, a lot of IPOs, and if Shadow Guy's still there, I think he and I were on Discord earlier. IPOs tend to do this. They come out and, oh boy, everybody's excited, and then they sell off. And it's usually the big giant investors that get in early. They get a really good deal. They sell their shares, and then the market crashes down. But this Robinhood's really gone up, and this could be also like a falling knife, right? Now, it's not as like crazy as this, right? Like this is really steep, but it is a concern. I've sold some shares of Robinhood, just thinking that, hey, very good return. And this is with a pretty nice little pullback that we've seen in Robinhood. We've seen from 65 to 49. So we've seen a nice little pullback. For the year to date, it's still doing well, but at one point it was up like 70%. So I'm trimming back my shares of Robinhood. It's losing more value overnight. And where will it stop? Well, Robinhood, I think, is still discounted because they, like Trade Desk, are very profitable. Except, what I like about Robinhood is they don't follow the rule book that Wall Street put out there. Oh, you're supposed to act this way and, do trades and charge people money. They're like, forget that. We're going to go zero cost trades. Boom. Market had to adapt to the way Robinhood was going to start operating. And now they're doing crypto. They have banking. They have, they're going to start doing gambling. They call it some polished word to try to make it sound like it's not gambling, but it's gambling. And I still think they're discounted by 37%. And I've been kind of saying that, hey, this business can continue to grow. Their cash flow is tremendous. And you think about what Robinhood provides. They provide financial services. It's not like, hey, they got to build a factory to make widgets. No, they don't have to do any of that. They just have to increase users, customers, and volumes. And they're increasing both. They're getting more customers and they're creating more products. Now they're going to come out with the gambling product. So they're going to grow. They're going to keep growing. So I still think Robinhood has some legs, but I am ringing the cash register and taking some of those gains. So that way, if Robinhood finds itself at $20 a share, I already cashed in my gains. I'm good. So that's Robinhood. So we covered Trade Desk. To me, that's a pass. It's not good enough. And we covered Robinhood. So we're good on those. All right. So somebody wanted to look at. So we're going to look at FTNT, which is Fortinet, which is a cybersecurity company. Now, cybersecurity is a necessity. And one thing that I'm aware of is this is a really competitive market. There's many companies that are doing it and they grow quite nicely, but I'm going to show you a couple companies. We're going to talk about Fortinet, Zscaler, and then SentinelOne. We can talk about CrowdStrike, Palo Alto, but let me get into this one. This one here is growing nicely, but no incredible growth, 12%. That's good, but not incredible. The last quarter, they did 17%. Very nice. Very nice. Now, when we look at Fortinet, they do have good margins, gross margins of 80%, free cash flow of $1.879 billion, growing it nicely. And based on like teens, mid-teens revenue growth, I would value this company at probably about 40 billion, maybe 50 if they don't have any debt and they have a really good polish to them. And they're priced at 83 billion. Man. So the cash flow doesn't support the market cap. And that's really being generous on that cash flow. Now, I'm doing that in my head because I do so many of these, and the model that I've shown you, this model, it's a model that I've created with all the right calculations, using finance. And I provide this to community members, access to it. It takes some knowledge of finance and kind of why do you use certain numbers and put in your cash flow forecast. But I do this so much that I can look at a company and say, well, it's going to land around here. So, and the reason I do that is, do I even want to spend time analyzing it, or do I just walk away? And that's why this one is a walk away stock, because I think at best it's a $50 billion market cap company and it's priced at 83. I'm looking for something that's like, has a market cap of 50 billion and it's worth 300 billion. Okay, that's the stock that I'm really looking forward. And I want to go and analyze that, and I want to put it on my watch list, and I want to buy it. But this one here, no, I don't think so. I'd rather grab, and I'll go right to Zscaler, and then I'll go to SentinelOne. The reason I buy into Zscaler, and I don't have a lot of stock in it, is we saw that our friends over at Fortinet were growing at mid-teens. These guys are growing at 30%. 26% in the last quarter. That growth rate is really good. Okay. And they're profitable and they have great margins, and their free cash flow, really good free cash flow. And when I value this company, I get a good discount on the stock. So that's why I'm investing in Zscaler. Is when you look at the fundamentals of companies and you put them into these financial calculations, they tell you what these companies are worth. And I'm not going to try to kind of give you a finance education like on a live stream, right? I graduated in accounting and we had to take finance classes, and they made us do all this arithmetic that was like, wow, man, this math is hard. Okay, cool. We did it. And then I did an MBA. And when I did my MBA, I found the finance arithmetic to be more interesting. And that was really cool. And plus computers really help us with this stuff. Imagine doing all this by hand. Like back in 80 years ago when Warren Buffett's, well, that's an exaggeration. 70 years ago when Warren Buffett was 24 and he's like, oh man, I want to analyze this company. He had to do all this stuff by hand, like pen, paper, or pencil, paper, and or maybe chalkboard. It must have been much harder. But you put this forecast out there, and what you're doing is you're buying this investment that's going to give you over time what is valued today a $46 billion asset in the form of cash flows. Okay. Study financing, you'll this light bulb will come on. Read books, this light bulb will come on. And maybe some of you guys that are watching, you guys, the light bulb's already on. You understand that. Then I add cash takeaway debt. So I'm seeing a differential between the true value of Zscaler and its market cap of 57%. And that's why I'm buying Zscaler. When I look at CrowdStrike, I see an imbalance. This one is a crowd favorite, no pun intended. And these guys are just priced too high, way too high. So I'd rather own Zscaler, and I'm happy with it. So the last one we're going to look at is Sentinel-1, I believe. And you see how many companies are out there? This is a crowded field. These software companies are not unique. They are providing something similar. There's no dominant player. The best business I can find is like Google search. They are so good. Nobody else can compete against them. Google search is the best. Meta, Facebook, Instagram, and WhatsApp, they have over 4 billion people logging into those systems every month. That's how good they are. Those businesses have, the competition's gone away because that one business is so good. The cybersecurity industry is not like that. There's like, and I'm not exaggerating, like 25 competitors. With that much competition, these guys are constantly taking each other out. And that's part of the reality in cybersecurity. These guys are riskier. When I look at them, they're exciting, good growth, but they're riskier because their profit margins aren't there. They're not that big, right? They're small. These guys could become something really interesting. They have a small cap. These guys might be worth following. Right now, they have very high PE, especially as we see a declining market. When you have a correcting market, these small caps tend to just get destroyed. Their stock prices get just destroyed. This stock price could go down to $10 a share. Then these stocks get really, really interesting because you're like, man, I'm getting this thing for a song. Over the 1 year, this thing hasn't done much. But if you look at Zscaler, I think the 1 year is also kind of bad. It's down 16%. It's not overpriced. Year to date, it's up 9%. Fortinet, with the 1 year, it's up 60%. Year to date, up 15%. So this one's been working. It's a crowd favorite, but I just think it's overpriced. In the near term, the stock market is a voting machine. It's a popularity contest. Hey, Fortinet, CrowdStrike, those are the cool stocks. Okay, great. Everybody's voting with, nobody's going to frown on me for owning Fortinet. It's a cool stock. Look, it's been going up. And this is rear view mirror investing. Like when you drive your car and you see the rear view mirror, you see stuff that's behind you, but you're not looking forward through your rear view mirror. When you look forward, you're like, okay, those are the turns I'm going to have to make. And what you got to see is the fundamentals. This is your windshield. This is what's telling you this is a high PE compared to Zscaler. And this is a high PE. But the other fundamentals like free cash flow, market cap is much lower. So you're getting a company that's in the same industry for a far lower total cost if you measure all the shares. So you do your analysis, and what I do is I analyze all the companies, right, that I think are in a peer group, and then I pick the one that I think is going to make me the most money. I'm going to go with that one. And that's how I go about it. So that's covering Fortinet, Zscaler, and Sentinel-1. Okay, so let's talk about let me see here. Any comments out there? I think we're good. So James Neals, you're saying Pelosi invested in Tempest One. Yeah. Crazy. And I guess some people invest based on what Pelosi is investing in. Oh, Confluent. Yeah. I've been watching Confluent, Sergio. That one looks interesting. Hood is down because BTC is also down. Yeah, you could be right. I think it rallies with Bitcoin. And then Teladoc, Jerry G, Wednesdays. Yeah, Teladoc is one of those that it could do well. I think we'll take a peek at it, but man, that stock's really been through a lot. And I should say the investors that invested in that company have been through a lot. It's kind of a brutal existence. So Evolution, yeah, I've seen this one before. So Evolution AB develops, produces, markets, licenses online casino systems to gaming operators in Europe, Asia, and North America. Small cap, 15.77 billion, revenue 2.29 billion. P ratio is nice and low. The 1 year it's down a lot. 5 year it's up nicely, but the 1 year is down. Year to date, it's pretty flat. Today it didn't do much. It just went down 0.21, which isn't bad. They already announced their earnings. And they are growing. Look at that. Nice growth. Margin, 100% margin. So they're licensing their product. So that looks good. This is a small cap. I'm not familiar with their industry. One thing, they're in Sweden, gambling. The way I'm investing in Europe right now is through an ETF. This one, the reason that I ruled it out is there's just a lot going on here. It's in Sweden. I don't really know Sweden. This is a company that develops and produces casino systems. Well, are they good or who do they compete with? That's a market that I'm not familiar with. So I don't have the knowledge to really make a good investment here. So I disqualify myself and I'm not going to invest in this company, but I can tell you that the fundamentals look good. PE looks good. Growth looks good. Free cash flow looks good. So if you do know this industry and you do know this company, and you think this is a very good company, the fundamentals look good. So good luck with it. All right. So somebody asked about new holdings. And I think it was Omar's like, hey man, should I invest in new holdings? Well, I don't provide any financial advice. I never suggest you buy, hold, or sell any stock that I ever cover. But I will share my experience. I bought new holding shares on Friday. Is that when it really went down? Yeah. So I bought some shares here. It came back today, which was really good to see that on a sell-off day, the stock came back, which is good. And it's rallying a little bit. This stock really is getting it done. It's growing nicely. It is in a country where you have a currency that's not stable. So a lot of the loss in revenue is because of that currency fluctuation, but they're operating the business really well. And over time, I think that currency hopefully stabilizes. That is one of the risk factors of new holdings, that it's in Brazil and does business in countries that don't have the most stable currencies, but it's growing really nicely in Mexico. It's growing in Colombia. I know those two economies are doing well. And they're also in Uruguay, Argentina, Germany. So they really have, their operations are in multiple countries, and those countries have a lot of people that are unbanked, and I think they're going to have a big addressable market to grow in. So that's why I'm an investor in new holdings. Now, do I own a lot of shares? No, I don't own a lot of shares of new holdings. It is a riskier stock, but over time, if they perform really well, I could see myself investing more. Their book value is low compared to book value of a US bank. So I'm not using book value when it comes to new holdings, but their earnings are really strong. So I think the stock's worth more, especially with the growth rate that they've exhibited over time and the region. I like the region. I own Citibank and I own New Holdings. Citibank is a nice, boring American stock. It's done really well for me. And I own a little bit of New Holdings. Now, I'm an older investor, but even if I was a young man, like 25, I don't take unnecessary risks. Like I manage a portfolio for my 24-year-old son. And I would never just say, well, I'm going to bet big on this one stock because it's super risky, but I can triple my money in a year. I think you'll end up losing a lot more money than gaining. But if you find good businesses that you really believe in and you make bets that way, I think it'll pay off. His portfolio is killing it. So that's great. And I put him into investments like New Holdings, Netflix, Meta. What's another winner? He's got some really good winners in there. And he's trying to do a PhD. So he doesn't touch his portfolio. I do everything for him. And hopefully someday he's going to wake up and have a nice pile of money there. So that is my evaluation of New Holdings. Good luck with it. All right. So somebody asked about cocoa. So the Vital Cocoa Company develops, markets, distributes coconut water products under the Vita Coco brand name in the US, Canada, Europe, Middle East. $2 billion company. They were growing nicely, but their growth is really plateaued, and now it's negative growth or contraction in the last quarter. When we look at the year to date, the stock's up a little bit, and it's up a lot for the 1 year. Wow, that's really good. So this is revenue of 594 million. Forward P is really high. Man, I don't like beverage companies. I'll tell you that much. And the reason for it is usually the margins aren't very good. These guys have gross margins of, call it 40%, profit margin of 12%, which isn't bad for a beverage company. Now, they are different, right? I've never heard of coconut water companies. I think I've noticed these guys, but I don't think I've ever had their product. They do have a little bit of free cash flow. But that little cash flow with the revenue that they have, this company is maybe worth 1.5 billion. And let's take a look at see how much debt they have. So they have total debt. So they have cash surplus. So yeah, these guys are worth 1.5 billion or so. And I'm not really interested in beverage. It's a consumer staple. You know, some people are doing well with this, right? Can't argue with that. 150%. Good. Great. I just, I pick industries that I think I could do well in. And beverage is not one of them. It's just the established beverage companies, they go up a little bit over time. And I'd rather figure out, how could I find the next Robinhood or the next Meta or the next, really, really cool stock that I could, like I have a software background. I have a background in certain industries. I'd rather use that knowledge as opposed to go over a beverage company. But if this is something that you understand and you like, this has been doing well. I think this stock is overpriced. Analysts agree with me that, hey, it's overpriced by some. Some analysts are really pessimistic at $28 a share. The most optimistic one just has a little bit of upside, but on average, they're saying this stock's a little too expensive. Their growth is going to be better than probably industry norms around beverage because those guys just grow 1 or 2% per year. These guys are going to grow faster, which is why the market likes them. So, and they are unique. They're doing something that, again, I don't think there's a lot of coconut water kind of companies. These guys are very unique. The other thing I'm concerned about these types of retail products is it's kind of a fad, or one day the consumer really likes it and the next day they don't. It's like, oh no, nobody likes Vita Coco drinks anymore. And you find it very hard to sell the product because maybe consumers wanted to try it. So you have some growth because they tried it and then they don't like it anymore. So good luck with it. It's not my preferred industry, and I usually just disqualify myself on it. But an industry that I really like is food delivery, grocery delivery, ride hailing, and so forth. Maple Bear, which is Instacart. This stock's really worked. Look at that. Boom. And over the 5 year, and they IPO'd recently. So looks like they IPO'd in early 2024. So they're doing well. Very nice. Very nice. 12.6 billion, not overly expensive. Forward P is 31. Their growth is good, but not crazy good, right? Just 10%, 11% there. And these guys, the stock really did well for the 1 year. And they're growing a little over 10%. Margins are good. Of course, they do the grocery, and they're beginning to monetize the advertising on their website. So when people are shopping for groceries, there'll be ad placement, and Instacart will charge these consumer packaged goods companies to advertise through the customer experience when they're on Instacart. That's a very good idea. Profit margins there, so they're profitable. Free cash flow is good. For a young business to be cash flow positive is very, very impressive. So 700 million in free cash flow. They're growing nicely. These guys are worth 14 to 18 billion, maybe even 20. And these guys were on my buy list. And like a knucklehead, I didn't buy them. Then they went up in value. Oh, man, the one that got away. Look at all this cash on the balance sheet. They have 1.3 billion. So these guys are doing really well. This is a nice stock. If this thing pulls back, I got to buy some, man. Because if it pulls back nicely, then I get my chance. I like Instacart. Making myself a note, but I got to put a little buy rating on Instacart. Let's see if I still have a valuation on these guys. I think I do. So here it is. Discounted by 31%. Remember how I said, hey, this thing's worth around this much? That's how I do the math in my head and get there. So this is discounted nicely. It could really, you think about, hey, are people going to want groceries delivered to their homes, for the next 10, 20 years? Absolutely. It's really convenient. I could see it growing, and of course we get DoorDash and Uber Eats delivered. We hail rides and all that stuff's now normal. It's going to be normal. So this is a good stock. This is a really good stock. I'm going to put a little comment on this guy. Got to find cart. Where am I at with cart here? So there's interest. Yeah, I have a buy rating and I didn't buy it like a knucklehead, man. So I got to see, the good thing about corrections is that these stocks keep getting better looking, like, oh man, this stock's really if it's discounted right now, and let's say the market keeps selling off and the market, for the NASDAQ, it goes down 10%, 15%, and Instacart, instead of it being a $49 stock, it gets taken down to $40 a share. It makes it even more attractive. So I'm going to watch this baby and probably get into it, but not too fast. Maybe this correction is going to take a while, but I am putting a little star next to Instacart. I like Instacart. I'm going to stay all over that one. TXRH. Next stock is Texas Roadhouse. So this is a restaurant. I don't like restaurants. Casual dining restaurants. Okay, cool. And the 1 year, it's up 15%. Not bad. Not bad. Year to date, it's down 4.64. Over the 5 years, it's up 140%. Very good. Now, Texas Roadhouse, if I'm familiar with their brand, I don't think I've ever been to one, but I think they're opening new locations. They have new store openings, which is part of why they're growing. And that's impressive that they're growing, but this is an industry with lower margins. They have to hire a lot of people. It just has a lot of things that I don't like. Look at these gross margins, 17.63. We were looking at software companies in the 80s, Nvidia, 80s, right? So I get to choose which stocks I get to invest in. There's no rule that says, Victor, you have to buy one restaurant or 10 restaurants. No, I'll go eat at a restaurant, but I don't have to invest in it. I'd rather invest in the next company that like a biotech company that produces a drug that's going to help people that have a particular illness and helps them. And that biotech company gets 85% margins and they get to have that market for 10, 20, 30 years. And I make lots of money. Okay, that's my investment. So restaurants are not in my investing plan. These guys, the low margins is what kills me. And their free cash flow is decent, 400 million, but it's, okay growth. I would study their new store openings. Same store sales is organic growth. That's the best growth of a restaurant. If they're just growing by opening new locations, it could be good, but it's not as good as organic growth. So 400, and I could maybe value this company at 6 billion, maybe 8 billion if I stretched it. Let's see what kind of debt these guys are piling on. They do have some debt, about 600 million. So this is a complete pass for me. I don't like the industry. I don't like the fundamentals. I don't like it. And they've been going up in value. I think sometimes, retail investors especially, they look at stocks and they recognize, hey, I've been to a Roadhouse. I had a good experience. And the restaurants are always clean and nice and fun. That's fine, but it doesn't mean it's a good investment. Like Nvidia, right? I know what GPUs are, but I have no idea like the circuitry and the complexity of them. And now, obviously, that was a great investment. But even Robinhood, right? I'm not a Robinhood customer, but I understand their business model, and I like their business model. I like their profitability and so forth, and I bought it, and that was a good investment. So be careful not to buy stocks because they're familiar in your life. I know that there was a famous investor, went up on Wall Street, author. He used to say, try to look at, your community and stuff. And I don't agree with that. It's just too nearsighted. Like, oh, hey, the garbage pickup guy. Okay, well, I'm going to invest in waste management. Well, maybe it's a good investment. Maybe it's not. Hey, I'm wearing, tennis shoes. I think I'm going to invest in a footwear company. Maybe, but you're kind of being nearsighted. Push yourself. Like, go figure out, like, look at the top 10 most valuable companies. What industries are they a part of? Software, technology, communication services. Go study those and then go find small businesses that are in those industries that are going to go from, 10 billion in market cap to 100 billion in market cap. They're going to take your $10,000 and turn it into $100,000. They're going to take your $100,000 and turn it into $1 million. That is what I would encourage you to think about. And restaurants, they're not going to get us there. They may have a nice run, but I challenge you to show me, of the most expensive companies on the exchange, how many restaurants are up there? None. The outside of technology, you got Eli Lilly, that's almost at $1 trillion. That's a pharmaceutical company. You have semiconductor, you have software, communication services. You have Berkshire, who's a diversified business with a big stake in Apple. So that's my comment on Roadhouse. Is I don't think they're valued. I don't think their intrinsic value based on free cash flows is worth 11.5 billion. I think this is priced too high, and I don't like the industry. So thanks for asking. Good luck. And it's getting late in the day, and whenever I talk about a restaurant, it gives me a greater appetite. So as soon as I get done here, I'm going to go eat. All right. So Big Bear AI, I've looked at this thing. This is an AI, artificial intelligence solution. Of course it is. 1.5 billion. What's it doing? Year to date, it's up 33%. Of course it's up 33%. Let's take a look at this graph, because Big Bear AI. All right. So year to date, it went up really nicely. 167%. Boom. That's what I'm talking about. In 2 weeks. That's what you call appreciation. And it came down 39%. Now, is this business worth its market cap, right? Its market cap's 1.5 billion. So obviously the appreciation, this is a voting situation. This is a popularity. Oh man, AI, I can make a quick buck. Boom. Fly up, more than double my money quickly. That seems really attractive, but it's also very risky because if you get caught on the wrong place of this graph, you're gonna suffer. It's already kind of coming down, right? So these guys are 1.5 billion. They lose a lot of money. They don't have any PE. They don't make any money. Analysts think they're overpriced, and they're not even growing. They're so great, man. We all gotta buy their stock, but their customers don't think they're great. They're just barely holding their revenue on. And this is revenue that they're losing so much money on. Look how much money they're losing. Wow. These guys are very good at burning cash. They have like a furnace run by AI that burns cash. $100 bills. And then they burn more cash. No, thank you. Gross margins, terrible. This isn't even a software company, 27%. Profit margin, they only lose 109%. Oh my God. No, thank you. There's, so a business like that, if you think that they have this awesome idea, hey, their idea is going to be great. This is the next Facebook. This is the next Google search. This is the next Netflix. Okay, go for it. But I don't believe that's the case. And their fundamentals, this is like, I hate to say it, but it's like close to zero value. And if you look at their history, right? At one point, they came out exciting, and then the market goes, not so much. So it's 67 cents a share. And then the market, I could see why people are attracted to this type of return, 645. But this is bottom feeding companies that just don't have a strong business. They're not. Would anybody be surprised on this live stream if we woke up 5 years from now and these guys didn't exist? It wouldn't be a total shock. Now, if you look at a business like, established business, you would see, be like, yeah, I expect that business to be there 10 years from now, right? Well, you think about your investments, right? I want my money to be, there 10 years from now, 20 years from now, 30 years from now. I want it to compound, keep getting bigger and bigger and bigger. And these are not the companies that are going to get me there, because these guys are going to fold like a cheap suit. They're going to be falling knives. And I don't want to be a day trader. I want to be a long-term trader, make lots of money every year, make a lot of money every year. And by compounding, I'm pretty much, making my chances of compounding my investments, making a lot of money every year, that much more realistic. So no to Big Bear AI for me. And thanks for asking about that stock. Now let's get honest and talk about the honest company. Looks like one of the regulars, Michael Anthony, is in the house. Good to see you, man. The Honest Company came out with a different type of product. It's consumer packaged goods, consumer staple, excuse me. But it is a household personal products. I call them consumer packaged goods companies. And some actress, I forgot her name, started this business. 572 million, revenue is 368. Forward P is super high. 1 year, 60. Wow, up 63%. See, we looked at this company and then it started to rock and roll. All right, so why is this business interesting? They are growing, at a good clip. Free cash flow is there. It's just barely making it though. And then free cash flow barely making it. Gross margin is okay. They're losing a little bit of money. They were losing a lot more earlier. Again, I get to pick the industries I want to buy in. Consumer staples is not going to grow my wealth fast enough. So it's almost like dead on arrival. I only own one consumer staple company, Kroger. And these guys are like, man, it's not like they're going to come out with a toilet paper that revolutionizes toilet paper, or they are trying to come out with a product that's more wholesome, a brand that appeals to families, kind of wholesome, organic kind of products. Got it. But there's probably 100 companies like that. They have massive competition on the shelf of this grocery store. Not the right business for me. Is this one a good investment? I don't know. It's been selling off. It did well for the 1 year. It's done terrible for the 5 year. I don't think this investment is going to double my money over the next 5 years. So I would walk away from it. It's not the right industry. The fundamentals don't tell me, obviously, this is a really good value. Like, here's an industry that it's not my favorite, but I looked at it because they announced their earnings. I'm like, there might be something here. Over the 1 year, Owings Corning does roofing material for our houses and stuff. And I'm like, okay, well, that isn't the worst return I've ever seen. It went down 2% today. 5 year, whoa, hey, now we're talking. What are we talking about here? Okay, we're talking about roofing material. And okay, I know what that is. This is an industrial. Not my favorite industry. So 14 billion in market cap. It's been growing for the annual, growing nicely. Look at that quarterly, 23, 22. Hey, they may have kind of made a turn here and are beginning to really grow their business. Okay, now we're talking some nice fundamentals. So I'm not in love with your industry, but I'm beginning to fall in love with your fundamentals. 1.245. This is $1,245,000,000. Looks good. Gross margin's not awesome, but okay. Operating margin's good. Profit margin's okay. Free cash flow is pretty good. So this is an industrial stock. This is kind of a little safer. We know this business. These guys have been around since 1938. Forward P is 10. That is a good looking PE ratio. Dividend is not the best I've ever seen. Analysts think it's discounted. I can probably show a discount on this stock, especially with their current growth rate. This stock is maybe worth, they did about close to 1.3 billion in free cash flow. So I would just have to multiply it times 10 to get to the market cap, but I actually would multiply it times 15 or 20 because of their growth rate. So this would probably be worth probably like 18 to 26 billion. Well, that's not bad, man. That is not bad at all. These guys are growing nicely. So this one here, I'm going to look at it even further because I'm not opposed to going into industrial stocks. But like when we looked at the Honest Company, it's like, well, those fundamentals didn't speak to me. These do. This is like stable. Hey, dude, you're going to make money here. You may not like the business, but who cares? This stock could make me money. Okay, I'm paying attention. So I'm going to analyze this further just to kind of show that, hey, fundamentals can wake me up and catch my attention when I look at them. All right, we're rounding third, headed for home. Confluent, man. Confluent, I looked at it and this thing looks good. And it went up on a down day. Confluent operates data streaming platform in the United States and internationally. The company provides platforms that allow customers to connect their application systems and data layers, such as Confluent Cloud. Okay. And where are these guys located? Did I miss the location? Country, United States, Northern California. Okay. So 1 year down, 5 year down. Okay. $10 billion market cap, revenue, 964 million. They're losing money. Forward P is 88. Now, why did this one kind of register for me is look at this growth. And they are in an industry where as they get more customers, each incremental customer, it doesn't cost as much as the customers that came before it because of scale. And that scale is going to make these guys profitable. So let's take a look at the quarterly. This quarter ended December 31st. They grew at 22%, 261. When we look at these guys, they're still losing money in the quarter. They have a little bit of free cash flow. That's very good. And you see how the cash flow is growing. Scale. As they get bigger, this is going to get bigger. Gross margin, 74. Now we're talking, baby. Get me out of that restaurant stock. Let's talk about gross margins at 74. And as they get bigger, that gross margin is going to get bigger because they're selling what is going to be kind of a intellectual property, right? These are ideas they're selling. These are technologies. These are sciences that they package, and it's very easy to deliver and so forth. So this one caught my attention because it's making the turn. It's like, hey, everybody, here I come. World, pay attention. Because when I start going up, this baby could start going up. So this one's on my watch list. And actually, I need to do some homework on it. But this one's a watch stock for me because I am seeing potentially like, this could be a nice stock that's worth 100 billion at one point, right? So I'm going to pay attention to Confluent. I'm not ready to buy just yet, especially if we're having a nice correction. These stocks are going to get murdered. It's going to be like, bam, stock market's like, sell everything that's technology, small and unprofitable. And this is a software company. I'm going to watch this, and the company's going to keep operating, whether the stock price goes up or down. And I'm going to keep watching it. And I'm thinking it'd be a good use of my time following Confluent. So thanks for asking about it. All right, Teladoc. Now this model makes sense, but it hasn't been a great stock. 21 down, 21. You've only lost 90% of your investment if you invested 5 years ago. And oh man, that's brutal. Brutal. This is the Kathy Wood special. $2 billion market cap, revenue is 2.59. They don't make money yet. They lose a lot of money. And they've stopped growing. Whew. Can we get any good news? No, actually, they started contracting. Come on, there's got to be a little bit of good news in this stock. Just a little bit. Just asking for, free cash flow, positive. Okay, there's a little bit of good news. So this is potentially, we'll see how much debt they have. Gross margins look good. Profit margins, when they get bigger, they're contracting, so they got to fix that. We're not growing problem. So then we're not growing problem is a big problem for me. If you don't grow and you're small and you're not making money, why am I buying the stock? And then how much debt do they have? So they have a little bit of debt, just 345 million. Short interest, 13% of shares are being shorted. This is a pass. It's if there was revenue growth, I would pay more attention to it. But hey, guys, you got to start growing your business. If you can't grow when you're this small, you're never going to get profitable. You're just going to be an idea that never was received by the market. You weren't receiving revenues that paid you back for everything you were doing. There was no equitable market relationship. So this one's a pass for me. All right, guys. Been rolling for close to 2 hours now. Looks like we're 23 strong on the live stream. Thanks for joining. Michael Anthony, HLF. Herbalife, dude. Oh, man. Look at you. Hopefully you were making a lot of money on Herbalife. Look at you, man. Drop the mic. Nicely done, dude. Nicely done. So you can make money on this stock if you bought it at the right time. Interesting. Super small cap. Well, congratulations on that, man. What about BTU? And you know what? I'm sorry, Michael Anthony, but I'm going to need to get going, and I'm going to kind of scream through the next couple stocks, guys. And I apologize, but I've got to have some dinner and shut down my day because tomorrow's going to be another eventful day. You know it. All right, BTU. So I'm going to do flybys on these. Peabody Energy. So coal mining. So these guys were working back here and then they stopped working. So they're selling off. Forward PE. Strong buy. So these, it's a matter of, and this is Peabody. So they mine coal and they sell it around the world. Well, the Chinese still burn a lot of coal, so they're probably exporting to China. But I guess coal prices are down, huh? Probably because coal is used for steel, and steel prices are down. I guess the inputs into the steel industry are down, but their revenue's down. Huh. Okay. Free cash flow is down. In their heyday, their cash flow was good. They're making $1 billion of free cash flow. Yeah, this thing is going to go up. I would monitor and try to catch this thing when the commodity prices are in your favor, and you'll be rocking, man. These guys are in the energy sector, but I would actually treat them more like a materials company because they're not really producing the energy. They're mining for the fuel that's going to go into electricity production or steel production. So sorry, I'm short on time, Michael Anthony, but let's do quick flyby. Shoe Carnival. Is this your next Herbalife, man? So is this a retailer? So Shoe Carnival, together with its subs, operates family footwear retailer. Yeah. Man, I try to stay away from retail. 611 million. Man, Michael Anthony, the micro cap investor. Forward P 7.4. Man, look at that discount. So they're growing a little bit, kind of contracting, growing, contracting. So they're growing a little bit. They're 1.2 billion in market revenue. They are making some cash. Okay. So this one here, right, is the fundamentals. It's kind of like you can make the case that, yeah, this company is worth the fundamentals, but the industry is not super popular. Retail, tough. You got to lease out space, hire employees. You have theft. You have returns. You have a lot of undesirables, which is why the PEs are so low. I don't make it a habit of buying retail, and I can't think of the last time I owned a retail company. I know some investors make money. It's just not my game. This one's down substantially. The economy isn't doing great, right? Like for discretionary, not doing great. Nike's not doing great. So this one here, man, I'm sorry, but you're on your own. This is not my strong suit. I would stay away from this. I would have disqualified it based on industry and stayed out of it because, I'd rather spend my time finding the next 5 to 10 year winner versus just trying to catch something that's going to be a short-term gain. All right. Tech sector is overbought. Main sector selling off. I agree. Thoughts on AutoZone? I went over AutoZone. AutoZone is a stock that I think I mentioned Pat Dorsey early in the stream, and he owns AutoZone. He did well with it, but I think the best is behind this stock. When you look at the 5-year, wow, look at that chart. Man, Pat Dorsey. Dude, if I could pick that guy's brain. I've read his book. I encourage you to read his book. He's, I think, the best investor right now. He's the one that I've learned the most from. Some other investors are kind of, they have catchy things. And, all right, whatever. This dude, Pat Dorsey, he's a freaking, like, he's really good. He talks very clearly how he finds companies, and he finds stuff like this. And I like his process. And I was saying, I've read his book twice. I'm going to read it again because I got to figure out how the heck is he finding these stocks. So this, as I look at this stock, I'm like, wow, that looks really good. Now, the business is slowing down a little bit, right? We're getting down to like 2% growth. AutoZone is auto parts and stuff. And yeah, it's stable, right? But it's not exciting. But damn, that stock price really looks exciting, right? Free cash flow is not growing. So that's one problem. Okay, if you're not growing your cash flow, why the heck's the business going up in value? At $2 billion, this slow growth business, this is worth $30 to $40 billion to me. Now, Pat Dorsey did sell some shares in AutoZone, but I think he's kind of made a killing on this thing. So AutoZone was a good investment for that guy. Not my favorite investment, and I don't just buy based on what somebody else owns. There's like 7 stocks that I pulled out of Pat Dorsey's portfolio that I'm going to do analysis on and see if I can find a couple good investments there. So on Q. I think my computer just froze. What's going on? Sorry, my computer is freezing. I don't know if I lost internet. All right. Give me a second. Come on now. Or maybe stock analysis went down. Yeah, maybe stock analysis is having a moment. Wow, this is down. So what do these guys do? Quantum computing. Man, this is so far from today. This is not a space that I invest in. This is somebody else's investment. Because you're having to invest in a company and it's going to pay off in 5 to 10 years, maybe longer. It's like, whoa, you're going to be waiting for a while. Yeah. So not an investment I would make. But, you know, if other people make money on it, good for them. It's not in my process and my recipe for success. I want to find good businesses based on fundamentals. And the fundamentals behind this is like, there are no fundamentals. It's all, do you believe in the idea and it's going to pay off in 10 years? Oh, no, thanks. That's not me. NASCAR all out. There's only so much liquidity in small caps, especially as part of the market. Ross Cameron. Okay. That's a good point. Watch your video. Nice. Have bought 100. Good luck, man. Nice did go up today. One of the best in the business. It sounds good. Man, you guys are bringing it tonight. Yeah, very good. So BJ's back to retail, not my favorite, but I know that stock's caught the attention. And Sergio, good to see your comments. I'm gonna need to kind of blow through them. Sorry. And sorry, guys, I'm not gonna be able to cover any more, but I really appreciate you joining. You're joining 2 hours into it. I told myself I'd go an hour and a half, maybe 2 hours, and I'm a little spent. I covered 2, 4, 6, 8, 10, 12, 14, 16, 17 stocks. And then I had, reviewed the indexes and stuff. So I'm going to need to roll because I need to be somewhere in 30 minutes and I got to eat some food and then go meet with some people. So everybody have a good evening. I appreciate you attending my stream. Good luck tomorrow. We need to stay steady, man. This market could sell off more. We just got to keep thinking, how are we going to make the best of this thing? Finding really good businesses, buying them at the right time and making money. I'm still green for the year. Now, I'm not going to, hang on to that too long because for all I know, I wake up a month from now and I'm in the red. But I'm just going to keep seeing what the market's, kind of dealing. And I'm going to try to take advantage of it. If it's going to discount stocks, all right, I'm good with that. I'll buy stocks. If it's going to, go sideways, I have to figure out where are there, opportunities. There will be some. I'll try to find them. So thanks for attending. I will stream probably a couple of times this week. I'll try to give everybody a heads up and hopefully you can attend. And I really appreciate you attending this stream. Everybody have a good night.